The Australian housing market has seen a downturn with interest rates reaching historic highs, reduced borrowing power, causing house prices to decrease, and this has left many homeowners concerned about their financial security and many considering refinancing their home loan. But with the decline in property values, the question arises, is it the right time to refinance? In this video, we'll delve into the pros and cons of refinancing your home loan during a declining property market and help you make an informed decision that's right for you. We're going to start off with looking at the current state of affairs, whether it makes sense to refinance in a declining market, and then look at the pros and cons. The Australian housing market has experienced a significant decrease in value according to CoreLogic's data. The peak value was reached in May 2022, but has since then fallen by a record 8.4%. This decline can be attributed to the 9 consecutive rate hikes we've seen, high inflation and poor consumer confidence. Out of all major cities, Sydney saw the largest drop of 12.1% during the 2022 calendar year. In the December quarter of 2022, 80% of the country's housing market recorded a decrease in values, which is a significant increase compared to a 10% drop recorded for the same period for the previous year. If you find value in these videos, please consider hitting that subscribe button as it really helps the channel. And a big thank you to all our subscribers. Your support inspires us to create more content. We hope you enjoy. So you're probably asking the question, should you refinance in a falling market? The refinancing decision for each individual is unique, and it depends on your personal goals and needs. Reasons for refinancing can vary, such as securing a lower rate, tapping into equity, merging debts, or releasing guarantors. There is no set time frame for when is the best time to refinance. It all depends on what you're hoping to achieve. For example, refinancing may be a good option if your goal is to get a lower interest rate. But in a falling property market, it might not be such a good idea if you're hoping to access equity. Therefore, it's important to weigh up the pros and cons before deciding if now is the right time to refinance for you. Let's start off with the pros. The first is a lower interest rate. Refinancing may be a solution to reducing the interest and monthly repayments. We've seen 9 consecutive rate rises. Interest rates have become increasingly high, leading to higher repayments and mortgage stress for many. By refinancing to a lower rate, you might be able to alleviate some of that financial strain caused by the current interest rate environment. The second is to pay off your loan faster. By refinancing, you have an option to shorten the length of your loan. If you're willing to pay a higher monthly payment, you can refinance to a lender that offers the option to reduce the overall term on your mortgage. This can lead to paying off your home loan sooner and ultimately saves you money on interest that would otherwise be charged. It's important to note that this option requires you to pay a higher monthly repayment, and it's good to check with the lender if you're refinancing to a variable option with a lower interest rate to make sure they allow additional repayments or lump sums to be paid. And the third pro is that you can switch to a fixed rate. You can secure your monthly repayments by refinancing to a fixed interest rate. This can provide stability in the face of potential rate increases. Fixed rate home loans keep your repayments consistent for a set period of time, regardless of changes in the market. Although your home value may be decreasing, you can still protect yourself from potential future risks by choosing a fixed rate home loan. So we've talked about the pros, now let's look at the cons. The first is less equity. Many homeowners are worried as the decrease in the value of their home has led to a drop in the equity available. This drop in equity can impact the rates offered by lenders and even the likelihood of your loan being approved. The second is the risk of falling into negative equity. Negative equity is a situation where your home value is dropped below the outstanding amount you owe to the bank. In this situation, you won't be able to refinance your loan because technically you're lending 100% of the property value. In a lot of cases, when you refinance, the lender wants to lend at an 80% lend with no mortgage insurance or a maximum of 90% if you're paying lender's mortgage insurance. If this were to happen, you may not have any other option except to stay with your current lender, increase your monthly repayments, and wait until the property price increases again. The next, and is another one we're seeing a lot of at the moment, is lower borrowing power. Makes it even harder to get your loan approved. As rates have risen, This lowers your borrowing power, which makes it even harder to qualify for a home loan. You may be making all of your repayments and borrowing the same amount, but lenders may say that you can't afford the loan you already have. This is because the banks add a buffer when they assess your application, which is 3% on top of the current rates. So when they assess your application, they're actually looking at your ability to repay a mortgage at, say, 8% instead of what the current rates are, which is 4.5% or 5%, which means if rates have gone up since you've borrowed, you might actually not qualify for a loan now because of this assessment. The next is potential for additional costs. When your property value drops, the percentage of it that you need to borrow to refinance goes up, and this can be quite costly. Effectively, as soon as you're lending over 80% of the property value, that's where things like lender's mortgage insurance become applicable. You may still be able to refinance your home loan, but typically lenders require a 20% equity to avoid that lender's mortgage insurance. Now, there are some lenders that will actually waive the mortgage insurance up to an 85% lend, but they can charge higher interest rates. And the last con is that you have access to less equity. If you want to do a cash out refinance to access equity in your property, you may end up accessing less because the property values drop. This is where working with a mortgage broker like ourselves can help. We can do a valuation with a bunch of lenders and see what each lender actually values the property at. You'd be surprised if we got 3 valuations on the same property, we can have anywhere from 30 to 40, 50, I've seen up to 100 grand in difference between the bank's valuation for the same property. So I guess to summarize it all up, we know the Australian housing market has been facing challenges in the last year with interest rates reaching unprecedented highs, reduced borrowing power, and decreasing home values. And with all these rate rises, many home loan borrowers are considering refinancing in order to secure things like a lower rate. As we talked about earlier, there are pros and cons to refinancing that you need to consider. Did you know here at Hunter Galloway, we're mortgage brokers. We help people right across Australia. So if you're needing assistance with refinancing, feel free to reach out with us on 1300 088 065 or visit our website huntergalloway.com.au where you can fill in a contact form and we'll get in touch with you. Guys, as always, thanks for watching.